Now, and yes, it's a day in the markets where we are seeing the markets almost with the cuts of 1%, and the broader indices are showing cuts of almost 1.5% on the mid cap and small cap. But then what's in store? What's the trajectory ahead? Let's get connected with our senior colleague Sajit Mangat, who's getting an exclusive conversation with Chetan Ahya. Sajit, over to you.
Thank you, Kavita, for that. We are at the Morgan Stanley's India Investment Forum 2026, and with me is Chetan Ahya, who is the Chief Asia Economist for Morgan Stanley. Chetan, thank you very much. I know everyone has this question about the supply shock. It's not getting, seen the way it should have been. Why do you think the supply shock is not showing its effect, despite the fact that we have 1/5 of the global crude and maybe 30–40% of the global gas getting disrupted?
Yeah, essentially, I think there have been two big changes that China has made that has helped the global oil and gas markets. China has cut its gas imports by 45% and oil imports by 30%. And as far as oil is concerned, we've also seen U.S. exports improving quite significantly. In fact, if you take U.S. plus China, the swing in their imports and exports has meant that there has been an extra 7.5 million barrels worth of crude oil available to the global markets, i.e. rest of the world. And global oil consumption is about 100 million barrels. So we're talking about 7.5% swing in global oil markets because of these two giants, the world's largest importer deciding to import less and world's largest exporter deciding to export more. So that has helped the oil markets. And as far as gas is concerned, China has been able to activate coal gasification. At the same time, use alternative sources of energy, i.e. use and improve the plant load factor for thermal capacity. And therefore, they have been able to manage with 45% less import of gas. And that, in turn, has helped a lot of the emerging markets, including India. And we have less issue of supply shortages, particularly in gas.
How do you look at the entire supply shock, where while the crude and the gas supply has been, you explained it very well, why we are not able to see that kind of spike in crude or gas coming in. Economies, from an economy point of view, Asia is the largest consumer importer of energy. Why do you think that this supply shock is not falling out or having a falling out for many of the economies?
Yeah, so actually, as the Middle East conflict broke out, we were very concerned, and we even, in fact, reduced our growth forecasts. But we all have been underestimating the strength of the industrial supercycle that had been ongoing. And what we have seen is that the first quarter GDP numbers, whichever economies released that in the region, have been better than our expectation. So it's the strength of the industrial cycle which is overwhelming the downside from rise in oil prices and gas prices that everybody has in the region faced. So we think that the super cycle is a key story here, to the extent to which oil prices stabilize here or go down. The industrial cycle will still be continuing to be more powerful trend driving growth in the region.
When you say that industrial super cycle, it's basically the kind of investments that have been made and the industrialization which is happening. Is it specific sector? Is it only limited to semiconductors and AI kind of thing, or is it's across sectors that you're seeing in the Asian markets?
So this is quite a broad-based trend, and there are 4 segments which we think are important drivers in areas of Capex. Number 1 is AI and AI-related digital infrastructure. Number 2 is energy. Number 3 is defense. And number 4 is industrial Capex. Now, industrial Capex is also seeing the spillover of all the other 3 sectors that I mentioned. But at the same time, there are a lot of subsectors in which various economies around the region, and in fact, this is a global trend, everybody wanting to onshore a part of the supply chain. So this is triggering a big global investment trend in all these 4 sectors. And we expect that these high growth sectors will grow at a 10% compound annual growth rate in dollar terms. And this compares with when you think about the overall capex in the region, it had been growing in the last 3 years at the rate of 2.5% in dollar terms. Okay. So there is going to be a big pickup in this capex cycle, particularly in these high growth sectors.
That makes you contrarian to the consensus which is there, right? In the sense, everyone is talking about how Asian economies may see a slower growth rate coming in because of the shock that we are seeing, West Asia shock, which is there. Having said that, we don't know when this crisis will get over, the West Asia crisis, but it will have a spillover effect. It will have a second order impact across companies and geographies. How do you perceive that? Are economies resilient enough to manage that kind of secondary shocks coming in?
Yeah, so there is, of course, some damage that is coming in through. Typically for emerging markets, the two sources of concern that will emerge when oil prices go up is one is inflation, and second is current account balance. It's only few countries in the region which are running current account deficit. That's India, Indonesia, and Philippines. Everybody else is running current account surplus. So starting point of current account balance is better generally across the region. And even within those three economies, it's really Philippines which had somewhat higher current account deficit. India and Indonesia's current account balances were also quite low before the Iran conflict emerged. And even after the Iran conflict and higher oil prices, this is not going to blow out as a current account deficit issue. Similarly, on inflation, across the region, inflation had been low at the starting point. So this is very different from what we were going through in, when oil prices went up because of Russia's invasion into Ukraine. At that time, COVID shock had already kept inflation at a high level, and so this came as an additional challenge for everybody. But in this cycle, because of the existing macro stability indicators situation being better, most economies have been able to absorb this in a manageable way. One other thing which has happened, and maybe this is after COVID, that fiscal intervention has become far more active. So when we look at the average crude oil price increase in local currency terms in the region, it's gone up by 50 to 55%. But retail fuel price increases have been more in the range of 17 to 20%. So you could say that only a part of the shock has been transmitted to the consumers. The balance has been taken in some form or the other into the fiscal accounts. So that has also helped manage this shock better.
You spoke about the current account deficit part of it, and India faces one of that. And one of the challenges for that is as well the currency which is getting depreciated and more pressure on the currency which is coming in. How do you view the entire thing? The way the central bank and the central government has been able to manage or handle the current crisis? Do you think there is more intervention that is required? And you yourself mentioned that they've absorbed a lot of the impact themselves and passed on only a marginal to the consumers.
So I think the approach from the government has so far been very similar to what other emerging markets have been taking. So you do pass through some to the consumers and put some in the fiscal balance. And then the other issue is about how do you manage your currency, because you are going to see some currency depreciation pressures, and that's also again across the region with varying degree. Of course, India has suffered more, not only because of the current account issue, but also because of the balance of payment challenges on the capital flow front. But we don't think that the management has been any different from what everybody else has been doing. I think there is still a need to separately address the issue of capital outflows rather, and its impact on currency, because from my understanding of speaking to the corporate sector, there seems to be some kind of a self-fulfilling aspect of this currency depreciation that is weighing on corporate sector's mind. And that has increased a lot of demand for dollars. And to kind of reverse this expectations effect, we need to augment capital flows on a short-term basis. And that can help. And the other solution is to work for competitiveness of the manufacturing sector, because if you have the competitiveness in the manufacturing sector which is improving at a rapid pace. Not only will you get more capital inflows, but it will also help to build a current account surplus buffer to manage these kinds of adverse dynamic that can emerge.
And in your opinion, what kind of tools can be used to arrest this capital outflow? Because a part of that is primarily because of the valuation that Indian market has, and the other thing is about the earnings growth, which is a challenging one because our growths are much lower than other countries where Japan or Taiwan or Korea, where the growths are in it's 100, 200%, and the lower P they're trading on. So how do you manage that kind of issue which India is facing uniquely actually?
Yeah, so look, I think since this sort of Capex super cycle has been unfolding, you have seen that those economies in North Asia particularly, which are far more advanced in this industrial cycle, have seen a greater demand for their products. And therefore, we have a very strong earnings growth in these economies. So if I were to just compare the numbers for Korea in the first quarter, consensus earnings expectations were 150%. And the actual numbers as it's coming out, it's more than that.
Yeah.
Taiwan is 48%, Japan is 33%, US is 27%, and India is about 12%. So I think this relative earnings growth differential has made investors reallocate capital from India into those other high growth, high earnings growth economies and markets. And this has added to the capital outflow challenge that India has seen. But mind you, this balance of payment challenge in India has been ongoing for much longer.
Much longer.
And so we think that to the extent to which it has got aggravated with this additional capital outflows in the equity market, and that have this oil price issue, there is a need to take up a short-term solution. And one of the solutions that we think could work is the RBI providing 200 basis point hedging cost protection for banks and state-owned enterprises to raise external commercial borrowings.
Okay.
It could be opened up to the private sector companies as well, and I think then we will get a huge amount of inflows. But then there is an issue about allocating taxpayers' money to the private sector. But if you just do it to the banking system and state-owned enterprises, even that can work as a short-term solution to augment capital flows. And the other measures that we are recommending, which are not necessarily short-term, but they can be implemented now to help in the short term as well, is to completely take out capital gains tax on foreign investors. And this is, the issue for the government tends to be that you are taxing the domestic investors, and why should you exempt the foreign investors? But it's the game that everybody is playing. So even developed economies are not, so you tax capital gains at the source. So whoever is the owner of that capital, whichever country that individual is residing, is paying capital gains tax. So I'm sitting in Hong Kong, I'm investing in the US, I'm not paying capital gains tax on the US assets that I own when I sell. So it should be taken up in that manner so that it's even keel and a fair game when you are thinking about competing on attracting capital flows from foreign investors, because that's the game everybody else is playing.
True.
And similarly, take out the withholding tax on for debt investors. And there, actually, when you look at the math in terms of the revenue that the government is collecting on tax on
LTCG and
the interest income on foreign holders of Indian debt. That is tax revenue is like 3 basis points of GDP. So it's not even that there is going to be any revenue loss meaningfully to talk about. So yeah, I think these two additional measures can help from a future investment perspective. And on capital gains tax, should be done for prospective investments, so that you don't run the risk that you remove capital gains tax, and actually at this point of time people will take the advantage of booking in gains in India without paying taxes. So it can be done prospectively to address the capital outflow risk on account of relaxation of capital gains tax.
It's interesting that you say that, because a contrarian could be that if the argument is on valuation, the argument is on growth, earnings growth, how will a capital gains, LTC's removal of capital gains impact, because you still have the same growth, you still have the same valuation which are higher than your peers, and you still won't get the capital flows coming back.
No, I'm saying that this is more from the medium-term perspective.
Okay.
And it's also that, like, what investors, when I'm speaking to them, they're saying that, the returns on a relative basis are not attractive. Plus, I have to take these additional issues. And it's just adding on to their, aversion to invest in India. And that issue has been basically debated at length before.
Yeah.
So one investor, and it's a story that is applicable to all investors. So when you, as a foreign investor, portfolio manager, sitting in Hong Kong or Singapore, investing in Indian equity market, if Indian stock holding prices go up, they have to, in their net asset value that they show it to their investors, actually already account for the capital gains tax. And from day one that any returns generate in Indian stock holding, they are underperforming MSCI index.
Okay.
Because the index is not taking care of the capital gains tax liability.
The portfolio is.
But the portfolio manager has to account it, because if there is any redemption, you can be not collecting that potential capital gains tax liability from that individual. So, these are the complications that the investors are going through. And they are saying that I'm having to do this only for India. So I think it's also these other additional constraints which are adding on to their aversion to invest in India.
You came out with an interesting report. The industrial supercycle is going to outweigh the oil shock for the Asian economies. If one way to put that parallel in India, where the Capex, the government Capex, which has been there for the last 4-5 years and every year is increasing, it's also playing out. Do you think that Capex will also be able to help outweigh the impact of oil shock?
Absolutely. I think India is also going through the same benefit of this Capex supercycle. And for India, all of those segments are relevant, but energy is actually very big in terms of the overall size of Capex that I'm seeing across the region. So if I were to just give you an example, AI Capex in the region is at $150 billion. This is the hyperscalers Capex in AI. The semiconductor companies' Capex is another $110 billion. So even if I include semiconductors Capex, it's $260 billion. Just the energy sector investment is $1.3 trillion. Okay. So energy sector investment right now, as we speak, in 2026, is going to be about 4.5 times that of the AI Capex. So that is also the case in India, that energy sector is going to be attracting a lot of investment, and the government is putting in right policies for attracting that investment. So we think, yes, this is a story that is applicable to India as well. The only difference between India and rest of Asia is that rest of Asia is benefiting from exports in these sectors as well. So in each of the sectors that I mentioned earlier, they have an export opportunity. And right now, we are seeing that their exports in those categories are booming quite aggressively. Whereas in India's case, it will see the benefit of domestic Capex getting invested, domestic amount getting invested in these areas and improving productivity and demand for certain goods. But it will be probably not benefiting as much as the rest of Asia in form of exports.
One interesting fact which is going to play out is the way central banks are going to react, and the commentary into how it's going to change globally as well, whether it's a Fed, whether it's the Reserve Bank of India, which is currently meeting for its MPC. Do you see a sizable change in the commentary and the language with respect to how they're going to manage growth and inflation? Because growth used to be a earlier target for everyone. Now it's inflation management which is there, which a large part of it is not under their control and they don't know what's going to happen.
You're saying more prospectively, inflation is also going to come into equation as a challenge for the central bank. Yes, I think that is going to be a case for everybody across the region, so in India as well. But as the governor has articulated himself, that they would be looking at the second round effect rather than the first round effect on inflation with higher oil prices. And we concur with that approach. We think that, in this context where you have this oil shock, unless you see that this oil shock is becoming a more long-lasting one, and in our thinking, what we are watching very closely is there a risk or is there actually another round of conflict, hot war that emerges? If that emerges and there is more permanent damage to energy infrastructure, then we think that the energy prices will also get parallelly elevated and stay there for a long time. And that is something that the central bank will have to then put into their forecast of inflation. And therefore, they will have to respond to that with interest rate hikes. But at this point of time, we think the approach which the central bank has taken here is the correct one.
Okay. And how do you look at the entire prospects of emerging markets going ahead with the first rate hikes compared to the developed markets?
So within emerging markets, it's really been sorry, the question is that, are the emerging markets right in taking up the interest rate hikes? Yeah, so no, India is not taking up. It's Philippines and Indonesia which have taken up. And their interest rate hikes are driven by specific idiosyncratic factors. In case of Philippines, they were running a current deficit of 3.6% before Iran conflict emerged. So when oil prices went up, they had to do an aggressive pass-through. In fact, they have increased fuel prices by 60% plus onshore. That then lifted their inflation, and therefore the central bank had to respond with interest rate hike. Also, that their fiscal balances were not good before Iran conflict emerged. So that's why they had to actually do that pass-through and not do the subsidization. In case of Indonesia, their reserve levels are low, and they also have a specific mandate for the central bank, which is very different from all the other emerging markets. The first line in the mandate from the government and parliament to the central bank is you have to manage a stable rupiah. So if your central bank mandate is to manage a stable rupiah, if rupiah is unstable, they have to respond with interest rate hikes. Plus, they don't have adequate level of FX reserves to endlessly intervene in the FX market. So I think those are very different cases versus India. I think India needs to take a call on the basis of just whether there is a second round effect of these oil price rises. I don't think there is a debate, again, in India, when I'm speaking to investors here, whether the central bank should hike interest rates to manage currency. We don't think that's the right response. If you think that you should not contaminate your monetary policy decision with FX stability, you need to respond to FX depreciation, but only on the basis of a estimation that this FX depreciation is then going to result into second round effect on your inflation, but not to directly, keep a stable, fixed level of exchange rate.
So how are you penciling in growth for India in 2027, given the fact that we have all these challenges? We have now added delayed monsoon, El Nino impact, which is also coming in. The RBI is expected to increase its inflation forecasts. There is a pass-through of fuel, which is now partially, which is now coming as well. And then you have the second-order impact, which may come in towards the second half of the year.
So we think, around 6.5%, 6.7% is our forecast, is something that is still achievable despite these challenges that we have seen on account of higher oil prices. And I think the most important issue that we were focused on is, are there more long-lasting gas supply shortages? Price impact is one thing. and physical quantity of a particular critical input not being available is another thing. And to the extent to which now, as you've seen, even to the fertilizer companies, gas is being released quite meaningfully. And there's a very small cut now. So that, I think, gives us the confidence that you're not going to see a significant damage to growth in India.
All right, so that's from the Morgan Stanley Summit. We'll get you more such interesting conversations. That was Chetan Ahya, the chief Asia economist. We'll get you more interesting conversations, but stay tuned to Buy Now Sell Now. We'll be back after a short break.